Most traders fail not because the market is too difficult, not because of unexpected news, and not because they lack analytical knowledge. They fail because of one hard-to-admit truth. They cannot control themselves when real money is under threat. Trading, on the surface, looks like a game of charts, patterns, indicators, and strategies. But at its deepest level, trading is a direct confrontation between a person and their most primal emotions: fear, hope, greed, and ego. And among all the tools a trader has, stop loss is the final thin boundary between someone who still has self-control and someone who is slowly slipping into illusion. When a trader says they don't need a stop loss because they can manage the trade manually, what they are really saying, often without realizing it, is that they believe in the moment of large loss, they will still remain calm enough to make the right decision. That assumption is extremely dangerous. The human brain is not designed to handle financial risk rationally under the pressure of loss. When money starts going negative, especially when the loss exceeds what you can emotionally tolerate, the brain switches from analysis mode to survival mode. At that point, you are no longer trading, you are praying. And once a trader enters a state of prayer, stop loss is no longer an option, it becomes an enemy. Hope is the most dangerous emotion in trading. It is not as loud as fear, not as obvious as greed, but it slowly erodes a trader piece by piece. Hope makes you believe the price has fallen enough. Hope tells you the market will bounce, just not yet. Hope gives you the feeling that if you just wait a little longer, everything will be fine. And because of that hope, you don't cut the loss. Not because you don't know cutting losses is the right thing to do, but because you cannot accept turning a temporary loss into a certain one. In the minds of many traders, stop loss is not a risk management tool, but a declaration of failure, and the ego does not want to fail. Look at the familiar behavior of traders who don't use stop loss. When the market moves against them, they don't ask, "Where am I wrong?" They ask, "When will price bounce back?" When price keeps moving against them, they don't think about protecting capital. They think about reducing pain by hoping harder. Each red candle is no longer information, but a psychological trial. Each passing day, the account doesn't just lose money, it loses clarity. And the cruelest part is this: the market does not care how much you hope. Price follows its structure, not your emotions. Many traders believe their problem is position size, entry, or timing. But deeper than that, the real problem is that they refuse to accept a fundamental truth. You don't need to be right in trading, you just need to survive long enough. Stop loss does not exist to prove you wrong. It exists to ensure that one mistake does not destroy your entire journey. A professional trader does not ask, "Will this trade win?" They ask, "If this trade loses, how much do I lose, and can I keep playing?" That is the difference between a trader and a gambler. The story of traders buying gold during a strong uptrend is a classic example. When a trend is clear, crowd psychology becomes extremely aligned. Everyone is bullish. Everyone believes price will go higher. And when that belief is reinforced by news, analysis, and community sentiment, traders easily fall into the most dangerous trap: believing the market must move the way they think. But the market has no obligation to meet your expectations. When price starts to drop, if you have a stop loss, you are stopped out. It hurts a little, but you still have capital, mental clarity, and opportunity. Without a stop loss, you are not stopped out. You are pulled into a toxic psychological state, being trapped. Being trapped is the worst state a trader can be in. You can't exit because you fear realizing the loss. You can't take new trades because your capital is locked. You can't think clearly because every price move directly hits your emotions. In that state, every decision you make is driven by a single desire: to escape the current pain. That is no longer trading, that is reaction. And reaction never produces sustainable profits. Ultimately, a stop loss is not a price level. It is a commitment to yourself, a commitment to accept being wrong, a commitment to prioritize long-term survival over short-term emotion, a commitment to never allow a single trade idea, no matter how convincing, to control your entire account. Traders who don't use stop loss often think they are more free. In reality, they are handing complete emotional control to the market. The greatest paradox in trading is this: the more you try to avoid the pain of a small loss, the more likely you are to suffer a much greater one. A stop loss being hit is a clean cut. No stop loss is an infected wound, slow, draining, and destructive without notice. The market does not kill traders instantly. Traders kill themselves by allowing a single trade to decide the fate of the entire account. There is a very dangerous moment in trading that few people talk about, when you are profitable and feel like you are doing things right. As the account grows, even slightly, the brain begins to reassess risk. You no longer see the market the same way. You start believing you have found the rhythm. Your decisions feel more logical, sharper, and most importantly, you begin to believe that if you are wrong, you will fix it in time. In that state, stop loss is usually the first thing to be loosened and then removed entirely. The Bitcoin trade story perfectly illustrates this. Before that, everything was fine. Consistent trading, small wins and losses, discipline intact. That is the ideal state of a trader in control of themselves. But once profits appear, the psychology shifts. Not into reckless greed, but into quiet confidence. You start believing you understand the market better. You believe you've matured beyond old mistakes. And when the market delivers a violent crash, the first emotion is not fear, it is opportunity. The brain loves reasonable stories. A historic crash, mass liquidations, extreme panic, all of it makes the idea the market will bounce after this sound very convincing. Logically, that idea isn't wrong. Many times in the past, markets have bounced after panic selling. But trading is not decided by whether an idea makes sense, but by how much money you put behind that assumption. The mistake here is not the market view, but the behavior that comes from believing you must be right. Opening a straight 10-lot buy in an extremely volatile market is not analysis. It is ego speaking. The ego says, this is a rare opportunity. I can't miss it. If I'm right, the profit will be huge. And in that moment, stop loss becomes something you don't want to see, because it directly contradicts the story you are telling yourself. Stop loss says, you could be wrong. The ego replies, no, this time is different. Very few traders realize that when you suddenly increase position size, you don't just increase account risk, you destroy the psychological structure you built before. A losing 12-lot trade may annoy you. A losing 10-lot trade activates your entire nervous system. At that point, you are no longer capable of normal decision-making. You don't cut the loss not because you don't know you should, but because cutting the loss means accepting that you just destroyed your own progress. And the brain will do anything to avoid that feeling, even hope. That day, the crypto market gave you no time to think. Price dropped fast, hard, continuously. In moments like that, traders stop trading systems and start trading raw emotion. You begin thinking that if you cut now, price will bounce immediately after. You fear the feeling of cutting and then watching it run. You fear emotional pain more than financial loss, so you freeze, watching the account bleed slowly while still believing you are right. Stop out is not just an account going to zero. Stop out is the moment the market forces you to accept what you refused to accept all along. You bet too much on a single idea. The most painful irony is this. After you are wiped out, price starts to recover. All the analysis was correct. All the ideas were correct. Only the risk management was wrong. And that kind of mistake is extremely hard for a trader to forgive themselves for. That feeling is not like losing due to ignorance. It feels like losing to yourself. You can't blame the market. You can't blame the news. You can't say you lacked knowledge. You know very well that if you had traded 12 lots, if you had placed a reasonable stop loss, you would still be in the game. You might even have re-entered and made significant money from the rebound. But because of one decision, you removed yourself from the game. This is the core lesson trading constantly tries to teach, but very few accept. The market does not reward being right. The market rewards managing the cost of being wrong. A trader can be right many times, but just one moment of uncontrolled risk can reset everything to zero. That is why stop loss is not a sign of weakness. It is proof of maturity. When you look back at blown accounts, rarely is the reason the market was too hard. More often, it's because you allowed a single trade to occupy too much space in your mind and in your account. You handed control of your fate to a random price movement, and in trading, that is unacceptable if you want to survive long term. There is a very hard truth in trading. The market does not care how smart you are, how good your analysis is, or how many times you were right in the past. The market cares about one thing only. When you are wrong, how much do you lose? And can you stand up again? Stop loss exists because of that truth. It was not created to help you win more, but to ensure you don't destroy yourself in your weakest moments. When you don't use stop loss, you unconsciously hand over all control to emotion. Every candle against you is a psychological hit. Each new low forces you to negotiate with yourself. You lower your pain threshold. You tell yourself you can endure a little more. And in that process, the identity of a disciplined trader erodes slowly. You don't collapse instantly. You collapse quietly, over time. A professional trader is not someone who never loses. They are someone who refuses to let a single losing trade define their trading life. They understand each trade is just one among thousands. It has no emotional value. It is not a reflection of who they are. When a trade hits stop loss, they don't see it as failure, but as the cost of survival. Just like a business accepts operating costs, a trader accepts losses to maintain the right to stay in the market. The most dangerous thing about trading without stop loss is that you start identifying yourself with the trade. When it wins, you feel smart. When it loses, you feel inadequate. And when price moves against you, you don't want to cut, because cutting then feels like admitting you were wrong, that you misjudged the market. But trading is not a place to prove ego. Trading is a place to execute a system, and that system doesn't care how you feel. Stop loss is the barrier that protects you from the worst version of yourself. The version that appears when you fear losing money, when you want revenge, when you want to prove you're right, when you believe this time the market must turn. No one is immune to that version, not even the most experienced traders. The only difference between survivors and those wiped out is this. Survivors don't give that version decision-making power. Many traders say they use a stop loss in their head. That is just another way of postponing a difficult decision. When price reaches the level you plan to cut, emotion is already too strong for rational action. You find reasons to stay. One more candle, one more zone, one more bit of hope. And by the time you are forced to cut, it's already too late. A preset stop loss is not inflexibility. It is removing decision-making at the moment you are least capable of making decisions. Rule number 1 in trading is not making money. Rule number 1 is protecting the account. Only when the account survives do you still have the chance to fix mistakes, learn, and capture truly big opportunities. The market will be there for a long time. Opportunities will always exist, but your mental clarity will not. Every time you break discipline, you make the next break easier, and eventually you don't lose because of one bad trade, but because of a chain of small compromises with yourself. Imagine if that was all the money you had. Not spare money, not experimental capital, but your livelihood. One decision to trade without stop loss can erase years of effort in minutes, and the most painful part is this. After you're gone, the market continues, still creating opportunities for those who remain. Trading does not forgive carelessness, even if your analysis is correct. So, if there is one thing you should remember after this video, it is this. Never trade without a stop loss. Not because the market is dangerous, but because you become dangerous to your own account in your weakest moments. You can trail stops when price moves in your favor. You can optimize risk-reward. But from the beginning, you must know exactly how much you are willing to lose if you are wrong. Trading is not gambling, it is a survival game. The winner is not the one who makes the most on a single trade, but the one still standing after thousands of trades. Keep discipline, protect the account, and let stop loss do the hard work your emotions will never do well. That's all.